When you take a look at the inflation print, the relentless strength in the greenback and just the hopeless policy and data divergence between the BOJ and the Fed, there's not much they can do.
There isn't much it can do unless the BOJ changes its policy. And to your point, at the moment, given the full commitment of the BOJ, dollar yen is essentially at the mercy of 10-year Treasury yields, which of course have gone up above 340. But importantly, when you look at history, 10-year Treasury yields tend to peak around where the cash rate peaks. And at the moment, expectations for the cash rate to earn well above 4% means that there's a lot of upside for 10-year Treasury yields over coming months. And in that sense, it also means that the prospects for high dollar yen levels, we should all be expecting now.
100 from the Fed. What would that do? Is that on your list of possibilities between now and next week? Will we have a better idea?
Our sense is that 75 is still sort of the more likely scenario, but the messaging will be important because, if they're very much committed to this aggressiveness in terms of hiking, particularly because of the fact that they want to see several lower CPI prints. And now we start from zero because the July lower print is sort of an anomaly. The August print is now in line with that 0.6% average in the first half of the year. So now we need to see several prints from here. So that means at least, you would think November, December is when the Fed will sort of change its tune.
Rodrigo, what will it take for any kind of change to come from the BOJ, given, of course, where the Fed is going, given where global central banks are going? I mean, this chart on the Bloomberg showing the history of yen intervention, the last time that we actually saw some sort of intervention from the Ministry of Finance was in order to weaken the yen. Will we see something to strengthen the yen coming from the Ministry of Finance or perhaps from the BOJ in terms of yield curve control changes?
Well, we think the pressure is rising. And of course, one thing we need to remember is that CPI print is coming on the 20th of September, which is 2 days ahead of the BOJ meeting. At the moment, dollar yen is at the mercy of higher levels from 10-year Treasury yields. So we think the pressure is increasing for the BOJ to do something. Now, in terms of intervention itself, history tells us that unless you have coordinated efforts coming from other central banks, intervention will prove to be futile. So to us, the key driver will be that CPI print near term. If it does print, above 3% or even at 3%, it will be a massive surprise. The market is looking for a print of 2.9, so it could happen. And certainly the pressure on the BOJ will increase. And as you say, what can they do? It will have to be an adjustment to the yield curve control policy.
What about pressure on other Asian central banks? Given the strength of the dollar, we continue to see foreign exchange reserves being depleted across the region.
Well, I suppose our general sense here is across not only just emerging markets, but also, countries that are suffering from a terms of trade shock from this energy crisis, is that, it's super inflationary, and the central banks will need to step up their aggressiveness in order to fight that inflation, even if it comes at the cost, or, regardless of what it comes at the cost of lower growth and even rise in unemployment.
When you take a look at some of the commodity and risk currencies like the Aussie, is it really the US dollar that's driving downside at the moment, or is there concern that we might see demand destruction?
Well, the Aussie, as you say, is a risk-sensitive currency, and at the moment, the Australian economy, the terms of trade is super positive. That is being reflected in the crosses. So the Aussie is performing super fine against the New Zealand dollar, against the euro and the pound. But when it comes to the US dollar, it's all about that procyclicality and the prospect of slower growth, the prospects of a Fed very aggressive in terms of its hike. It drives the US dollar higher and it weighs on the Aussie dollar. And we should be ready for lower levels if the Fed continues to be aggressive.
Across the emerging markets complex in Asia, what are you watching specifically, and do we continue to see the yuan playing that kind of anchor role within that space?
Yes, there's an anchor role, but our sense is that, for one, you look at China and inflation is not a problem. You look at China, it's slowing down, has massive headwinds coming from the property sector, whilst at the same time there's a huge confidence issue within the consumers because of the zero-COVID policy. So how does China get out of this problem is through infrastructure spending as well as the external side, the export side of the economy. And that's where lower CNY plays a part. But the POSC is essentially trying to slow down the depreciation of the CNY rather than prevent it. So that anchor role, as you say, is important, but is gradually moving towards that 7%, which we think will happen before the end of the year.
Shery just mentioned this, view that we see with account buffers being worn down across a lot of these emerging nations. Who's most at risk, and are we going to see a repeat of previous bouts of Fed tightening, or are these kind of financial houses in better order this time around?
In terms of history, I would sense that they are in better shape. But certainly, you look around and those countries that are suffering from that energy shock are the ones that are more exposed and also the more indebted. Like, for instance, in South America, Chile, despite the fact that it's better economically than others, it does have more exposure. So we have to keep an eye on how things develop as well over the coming months.